Hi, my name is Manoj Abhichandani, and today I will be presenting a webinar on CGT Relief. This is based on the new legislation, the TLA legislation, which came into effect on 1st of July 2017. It's quite important that advisors are aware of the new legislation because they would be now facing with a situation where they're preparing 2017 accounts and they're lodging the tax returns and should be aware of the new legislation. So what we'll do is we'll start the webinar in a couple of minutes. I can see quite a few people are joining in now. Um, and we'll just go over the housekeeping issues before I commence. In your panel, you will be able to see a phone number which you can dial via your phone if you cannot hear me via the internet. So you'll have a PIN number there as well. So if you want to connect to voice through the phone, it'll be much more clearer. I have a very high level internet connection plus a microphone, and I cannot do anything better than what you can hear. So if you can't hear me well, the only option you have is to dial that number and enter that PIN, and then you'll be able to hear me much better. The second issue is about questions. Again, in your panel, there will be some space where you can type in some questions. So because of the complexity of the issue, I would request you to type in the question, and after my presentation, I'll read through all the questions and try and answer as many as possible. And those who don't have a question can probably hang around after the presentation. And what I'm going to do is I'm going to read the question and try and answer it to the best of my ability. Now, the last housekeeping issue is to do with the handout. What you see on the screen is can be downloaded in your panel. If you can see, there's an area for handout, and it'll say CGT Relief from 1st July Melbourne seminar. So you can download it from there. Now, if for some reason, if you cannot download it from there, then you would have received an email from us about an hour back. So if you reply to that email, we can then attach it to your reply, and we can send you this presentation via email. But our preference is that you download it from your panel. Okay, so let's start and talk about CGT Relief. Let's first of all try to find out why we are in such a situation, and why it is so concerning, who does it apply to. So it's going to be a serious issue, and I haven't heard many accountants yet calling us regarding how to claim these reliefs, because I guess their balances are below 1.6 million balance transfer cap amount. So first thing you must, if you have a set of clients, the first thing you have to look at is whether the member is in pension and whether the pension amount is more than 1.6 million on 30th of June. I've got a little graph there, and very soon we'll find out what the issues are. So the CGT relief is available where the funds were on 9th of November when the legislation passed through Parliament, whether the assets were segregated or not. Now, segregated means that if the fund was in 100% pension phase, so all the assets belonged to members who were in pension phase, so they were segregated to pay a pension. So if those assets move from segregation to accumulation, that means the amount of the pension was more than 1.6 million on 30th of June 2017. So the member decided that a bit of the pension amount would be commuted and it will move to accumulation phase. Or if it was segregated, then the amount was moved, a certain amount was moved into an unsegregation a pool of assets where there were other members who were in accumulation phase. And I'm going to pictorially explain you that so that you're able to understand what I'm talking about. So if the assets were not 100% pension phase, but there were some assets which were segregated for pension members, so we removed those assets from the segregated pool of assets for pension members and we took it out and we put it where they were unsegregated assets. That means that there were some assets belonging to some members who were in pension phase and some members who were in accumulation phase. And I'm going to, of course, with a picture, explain you what exactly I'm talking about. Now, what is actually happening is that on a certain date, between 9th of November to 30th of June, depending whether you were using the segregated method on 9th of November or not, you are actually selling the assets, but the assets are not being sold. So it's a deemed sale. So when it is a sale, there could be a CGT issue which we need to address. So what is happening is that you're resetting the cost base. And once you reset the cost base, you look at your cost price and you look at the deemed sale price, and the deemed sale price means that there were certain assets. If it was a fund 100% in pension phase, that means any growth till that point will get the relief, the CGT relief, and then the new price, the new market price will be the new cost base of that asset. And if the asset is sold in the future for a higher price, then there will be no tax to be paid up till that cost base, and only tax will be paid for any growth further afterwards, after the asset has been reset, after the asset has been deemed to be sold and repurchased. Now, one thing we must say very clearly, that this applies only once to only 2016 and 17 years, and it will, if you miss this opportunity, then you will lose the relief forever. And the problem is that you have to choose, you have to elect, you have to make an election in the tax returns by the due date. Now, some of you have to look at the due date of your tax returns, because if you were a late lodger, then it is possible that your tax return is due on the 31st of October, which is this month. So any election has to be made in the tax return, and the tax return's due date is quite important. So why did the government think that we have to offer this relief? You see, all pension amounts were tax free. So you could have 5 million, 10 million in the super fund, and you could have commenced a pension, say, 10 years or 5 years back, and all that growth remained in the pension account. And because it remained in the pension account, it was all unrealized growth. And people, pensioners, were thinking that if it remains in pension phase, and the asset can be sold at any time, because the pension was 100% tax free at all times, immaterial of the balance of the pensioner. But what has happened is that from 1st of July, you cannot move more than 1.6 million, which is the balance transfer cap amount, into the pension phase. So the problem has been that all that growth, the unrealized gain, has to be captured and has to be quarantined and qualified as a relief. And that relief will always be credited, will always be given to the pensioner. And the government did not want all the assets to be sold out. They didn't want everyone to just go out there and sell the asset, and if the assets were sold, of course, before 30th of June, they would be all tax free. So there was a second option given to them. The option was always available, that you could sell the asset, and whatever gain you received could be tax free within the fund. But the option was given that instead of actually selling it, you could actually pick up a price, a market price, and that market price would be your deemed selling price. And any gain from there onwards would then be taxable based on how much you would have in that fund and how much would the pensioner have in that fund. So if the pensioner had only 1.6 million or below, so let's say the pensioner had only 1 million on 30th of June, there would be no need to claim the CGT relief, because going forward, it's below the 1.6 million balance transfer cap. So even if the fund increases from 1 million to 1.3 million, the assets are still tax free. Now, one thing to be noted here is that the balance transfer cap is to be tested on 1st of July 2017. So let's say for say example, there is another fund, one single member fund, and his balance on 1st of July, pension balance, and he's a single member fund and he's in pension. His balance on 1st of July, market value of all assets, is 1.5 million. And because he's below the balance transfer cap of 1.6 million, any further growth, so after 2 3 years, or let's say in 2020, after 3 years, if the balance is 1.8 or 1.9 million, depending on the rate of return and depending on the withdrawal amount, that growth will still be tax free. So all the income will still be tax free, because the testing time, whether the pension is on below the balance transfer cap or not, is tested on 1st of July. So any further growth is literally tax free. Now, the method to calculate was different, because they looked at funds. Some funds were segregated, pension funds. Now, let me just talk about what is segregation and what is proportionate method. First of all, because there could be some of the listeners here may not know the difference. Some assets are segregated, and segregation means that they are just kept away for those members who are on pension. So the segregation is not like a physical segregation. A segregation could be like naming the assets. So let's say we have Westpac shares and ANZ shares. So we can say that all the Westpac shares belong to all the pension members. So let's say we have a $2 million fund. We have some cash. We have Westpac shares. We have, say, ANZ Bank shares. So and let's say the member who is on pension is, out of 2 million, 1 million is in pension, and the value of the Westpac shares is, say, 800. So all those shares which are in Westpac belong to the pension member, to the member who is on pension. And the value is only 800, and the pensioner's balance is 1 million. So the remainder $200,000 of that pensioner has unsegregated assets. Some assets of that pensioner are segregated, and some assets are unsegregated. So we may have other members who have 1 million balance. So the pensioner has 200,000 assets which are unsegregated, and has 800,000 of Westpac shares which are segregated. So, and there are accumulating members who have $1 million balance. So $1.2 million out of the $2 million fund, assets are unsegregated, and 800,000 are segregated. So any income coming out of those Westpac segregated shares are allocated directly to the member who's on pension. And the $1.2 million, we have to look at the proportion out of the total. So 200 out of 1.2 million. So 1/6 of all the other income from the cash or from ANZ Bank dividend income would be on proportionate basis. That is, a certain percentage of that income will be taxable, and certain percentage will not be taxable. So once the asset is segregated, and it is supporting a pension, all the income, for in our example, the Westpac shares, all the income coming from Westpac shares would be credited to the pension member, and all that income would be tax free. So CGT relief is basically for those people whose balances are more than 1.6 million, because anyone below that level, their assets will always be segregated after 1st of July as well. And it is also for those people who were on transition to retirement pension, because transition to retirement pension assets which were paying a pension to a person who was working more than part-time basis, more than 10 hours a week. The reason for that is because all those assets will now be paying tax from 1st of July. Any assets paying a transition to retirement pension income stream would be taxable. So all those assets will remain in pension, but the income on those assets will be taxable. So any member going forward from 1st of July wants to continue the transition to retirement pension can also claim a CGT relief. Um, there is another session which I'm going to talk about, later on. That is, how can a transition to retirement pension move to an account-based pension? And there are certain criterias which you need to match, like you need to either retire or reach the age of 65. So we'll just leave that conversation for another day. Now, if the fund was only in accumulation, then you cannot get any CGT tax relief. So, if you're an advisor, the way to find out of your portfolio of funds which you look after, the first thing you have to look at is how many funds are in pension, and the second is how many members have a balance of more than 1.6 million. Now, those of you who are looking for some more detailed information, they should look at the Law Companion Guideline, LCG 2016/8, and you'll get a lot of details. Now, the balance transfer cap was introduced to limit the amount of capital which can support a retirement income stream, and it limits the amount of earning that could be exempt from tax. So the way the government saw was that the word they used was that it is unsustainable for people having large pension balances and paying no tax. So what they did was they capped the amount, and that was the balance transfer amount. They capped the amount which will move into retirement phase, and that's retirement phase is a new term again from 1st of July onwards. And this 1.6 million, they called it the transfer balance cap, and it can only move in 100,000 increments, and CPI doesn't move very quickly. So I don't see that for the next 5 or 6 years, this figure of $1.6 million is going to move, because it'll increase only by $100,000 each time. So the way the balance transfer cap works is that you can debit it or you can credit it, and it is over and above a pension account. So some of you who are looking after funds, you'll have to have a separate account. And at the moment, I've looked at the softwares which are available. They are not counting this transfer balance cap at the moment, but I believe they would be bringing updates. And if some have already, then I'm not aware of it. So you'll have to keep a separate account, separate from the pension account of the member, to track what is going up and what is going down into the balance transfer cap. And in the media, you would have heard that anything which is coming out of the balance transfer cap has to be reported, and we are still in the limbo on how often you have to report. And although there is a concession for 1 year, and the question is, the tax office wants us to report whether we have the capability to report as often the tax office wants us to report. Now, the balance transfer cap from 1st July, because it is 1.6 million, anyone who had a balance more than that amount had basically two options. One option was that if you had, say, 2 million, you could withdraw 400,000 out of the superannuation system, so that on 1st of July, you would move into pension phase, and you would be within the balance transfer cap of 1.6 million. The other option, which most of the people have taken, is because if you had money outside of super, it will pay tax at individual marginal tax rates. So the option people had, and they have taken that option, is to commute the excess amount. That means partially stop that pension and leave the money in the super system. And because it will be unsegregated, that means you will have a pension account and you will have an accumulation account. And segregation, by the way, is specifically disallowed from 1st of July. So all the assets will be unsegregated, they will be mixed. And if you have an accumulation account, and if you have other members who have an accumulation account, your pension assets will be mixed with all of the other, your accumulation phase and other members accumulation phase, and an actuarial certificate would be required. I'm going to talk a little bit more about actual certificate a bit later. Now, what is this transition relief? So first of all, we have to see which funds are exposed, and so you have to basically think about resetting the cost base. At this point of time, I must tell you that it's a option. You don't have to do it, but if you make an election, if you choose to do it, is irrevocable. So it's a bit of a problem because you don't know which way to go. But if the asset has grown quite substantially, let's say you bought an asset for 100,000 10 years or 15 years back. Let's say you bought BHP shares for, say, $10 and now they're $70, and they have substantially grown. So obviously, it'll be in your favor to take the CGT relief, because now it is reached $70. So your cost base will, instead of being $10, will be $70, and you'll be liable to capital gain only if it grows higher than $70 in future. So you really have to think that whether resetting the cost base is really worth it. And it will only apply to those assets which the fund owned on 9th of November, because that is when the legislation was introduced into Parliament. And you must understand that this election which you have to take is not automatic. So if you decide to do nothing, it's not going to work. So this election must be taken, and I've got a little picture of the tax return as well to show you where the CGT has to be displayed in the tax return. So if you think of it in a very superficial way, so basically what you're doing is you're selling it and you're repurchasing the asset at that market value. So when I say market value, so you must have a market value, must determine a market value. And I recently wrote an article of what is market value, because we considered certain assets which will have a disposable cost. So let's say if you had $1 million property and you had to sell that property, and you would use a real estate agent and pay $20,000. So will the market value be 1 million, or will the market value be $980,000? That is for you to choose and for your auditor to be satisfied that you have used the correct valuation. And ATO has mentioned many times in their publications that they're going to look at market values very closely. Now, when you sell an asset and when you when you repurchase that asset, and the cost base is reset, and if you sell it again, the same 12-month rule will apply from 1st of July onwards. So, you get 1/3 discount if you hold the assets for 12 months. So if you sell the assets sooner, you could be subject to 15% tax instead of the reduced tax of 10%. Now, the steps involved is very simple. You compare the value of the pension assets. If you are over 1.6 million, then yes, you're proceeding. Are the pension assets segregated or not? And if they're segregated, there's a different way of checking, the different way of electing, and there's a different, and if they were unsegregated, there is a tax component, and I'm going to get to that. So were the assets segregated or not on the 9th of November? And then you select some assets. So you don't have to, so when you make an election, you don't have to make an election for all the assets. You can pick asset by asset, and within that asset by asset, let's say Westpac shares, you might have bought Westpac shares in 10 different tranches. So you can pick certain tranches and you can ignore the other tranches. So whenever you make that election, you have to keep records. And this is going to be very, very messy going forward 4 years or 5 years from now. Reason being is that you might keep an election, and then when the client moves from one administrator to another administrator, somewhere down the line, that calculation is lost. And when the asset is actually sold, maybe 10 or 15 years later, we are not aware of the actual deemed purchase price, and the cost base may be lost. So it's very, very important that these records are kept. And unfortunately, the tax office expects the administrator and the trustee to maintain these records. So that puts extra onus on super fund auditors as well to maintain this record, not for the normal 10 years, but for a longer period, and hold on to these records till the asset is actually sold. Now, you might find this chart a little bit scary, but we'll just go through it very slowly, and then I'll explain you every component of it, and then you will see that it's not that complicated. So what we are doing out here is we're trying to find out whether there would be a CGT relief or not. So if your clients were in accumulation phase or they were in preservation age, so it's very simple. No, they were in accumulation, so no CGT relief. And they were accumulation for the whole of the period, like prior to 9th of November. So if the pension commenced on the 10th of November, so you don't have to worry about that. And how would you know that is because it's possible that some of your clients turned 56, because that was the preservation age for 2016 and 17. So if you commenced a pension after the 9th of November, so you don't have to worry about those funds, because CGT will not apply to them. So now we're looking at only those funds which were over preservation age and the pension commenced prior to 9th of November. So the pension was in place. And if the pension was less than 1.6 million, so we ignore that. So the pension was less than 1.6 million on 1st of July. So you just ignore those funds. So we are looking at those funds where the pension is more than 1.6 million. And the next point you have to check is whether the assets on 9th of November, were they segregated pension assets or they were unsegregated pension assets on 9th of November. Now, if the fund had only pension members, the assets were 100% segregated. So if you had two members and both of them were on pension, it's very simple. But if you had a member on pension, and if you had a member in accumulation phase on 9th of November, then obviously it is 9th of November date is important, and the fund was actually in unsegregated uh, in unsegregated mode. So let's just talk about if they were in segregated, and that's what I'm going to discuss first. So if it was unsegregated, you had two options. Basically, some assets would be transferred to accumulation, and the period you had was from 9th of November to 30th of June. You could move them. You could remove 100% pension fund. You could move it into accumulation anytime between 9th of November to 30th of June. Or the second option you had is that you transferred it into unsegregated pool of assets. And how would you do that? And that's very simple, because it was on pension on a certain date, and then maybe there was a contribution by one of the members or a new member joined in, and then you had an accumulation account in the fund, and then you moved certain assets from the segregated pension account into an unsegregated pool of assets. Now, if the fund had unsegregated assets, they were accumulating members on 9th of November, so they were mixed pool of assets, you would need an actuarial certificate, and I'm going to talk about that a bit later. So what we're going to do is we'll come back to this chart, and let's just discuss if the assets were segregated. So we've discussed, what is segregation. Basically, income on these assets belong to pension members only, whereas where the assets are unsegregated, that means income is shared between accumulating and pension members. Now, segregated asset, you had two options, which we looked at. The option number one was to move to an accumulation pool or move some of the assets to unsegregated pool of assets. And the move could have happened any day between 9th of November to 30th of June, because that is when the legislation came through. And you could use market value of the asset on the date of transfer. So the date of transfer could be 9th of November to 30th of June. So the deemed sale and repurchase or reacquisition can occur at any point. So the market value of that date. Now, why would you choose a date other than 30th of June? Because if you had a fund 100% in pension phase, what you could do is, let's say the shares went down after, say, 1st of January. If you pick a date of 1st of January, so the asset was of the highest value, say on 1st, and BHP was, say, $80, but on 30th of June, it went down to, say, $75. So you could take the price, the highest price for CGT relief, and you could move the BHP shares at $80, and then it goes into the accumulation phase. Now, if it goes into the accumulation phase, remember one thing, you will need an actuarial certificate from 1st of January till 30th of June, because it was no longer a 100% pension fund. You move the asset out of the 100% segregated pension fund into an unsegregated pool, and you moved it into an accumulation mode into another date. Now, if you move the asset on 30th of June, that means the fund was unsegregated for one day. And if the fund was unsegregated for one day, that means if the fund earned any income for that one single day, then it is possible that the fund will pay tax on that income. Now, a lot of banks pay interest income on 30th of each month. So you have to be very careful, because if you're going into unsegregated mode on the 30th of June and if you earned income, then it is possible that an actuarial certificate will be required if you want to claim exempt current pension income. Now, today's webinar is assuming that you are aware of the basic things why you need an actuarial certificate, because on 30th of June, you could have only 1.6 million into the pension phase, and the remainder amount so could be in accumulation. So you could have a situation where the member, let's say a single member fund, at 5 million or say 5.6 million on 30th of June, only 1.6 million is in pension phase and 4 million is in accumulation phase, and we earned $1,000 interest income. So if you want to pay tax on that 1,000 interest income, you don't need an actuarial certificate, because the tax would be 15% of 1,000, which is $150. But because 1.6 million was in pension phase and there was a certain percentage, so out of 4 million, out of 5.6 million, 1.6 million was in pension phase, there's a percentage of 1,000 which could be basically tax free. So you have to look at the interest income, or the income of the fund. Maybe the income of the fund could be 100,000 on 30th of June, and then you may want to claim a certain percentage, because 1.6 million out of 5.6 million was in pension phase. So you want to use a proportionate method. So in certain cases, it may be beneficial to actually, claim an exempt current pension income deduction for your fund. Now, the next point is very important, and it took me a long time to, to understand it myself, and I need to explain it to you. And you must. The next point is the capital gain is ignored for tax purposes. Now, and because you see, in the only difference between segregated method and unsegregated method is that in unsegregated method you have to work out the tax. Whereas in a segregated method, the capital gain is ignored for tax purposes. And let me just try and explain it to you in very, very simple English. Now, if the fund is in 100% pension phase, and if you sell that asset, there's no capital gain tax. And that is the only reason when you sell that asset or when you remove that asset from the segregated to unsegregated, that capital gain tax is totally ignored. So if the fund actually sold the asset in real, like sold it to a third party, all the assets or all the capital gain would be exempt. Since all that capital gain is exempt, when that asset is moved out of the segregation into an unsegregated mode, or when that asset is moved from a segregated 100% pension mode to an accumulation pool, there is no capital gain tax incurred because the fund was in 100% pension phase on that day when the asset was moved. So when that asset, say on 30th of June, came out of the 100% segregation fund, on 30th of June or the night of the 29th, the fund was actually in 100% pension phase. And if the fund is in 100% pension phase, all the assets are supporting a pension. And of course, all those assets which support a pension, all the income is ignored, all the realized or unrealized, realized capital gain is ignored. So this is a very important fact that you must look at whether the fund which you're working the CGT relief for, whether all the assets were segregated or not, whether the fund was in 100% pension mode or not on 9th of November to 30th of June. Now, after the move has happened, you must understand that if there is ultimate sale of that asset, the fund could actually be subject to tax. And if there is income earned by those assets, then it's up to you to claim, um, exempt current pension income, because some assets are in accumulation and some assets are in pension. Now, just so that you are aware that from 1st of July, you cannot have segregated pension assets, and you can look at Section 294-110 of the Income Tax Act. So segregation is no longer allowed from 1st of July. So what we are saying is the fund is 100% pension phase, and you could have a situation where the asset is more than 1.6 million, but the asset could be less than 1.6 million, but the total member balance is 1.6 million. So when the asset actually moves from a 100% fund, it could actually move to an accumulation account because the value is higher, or it could move into an unsegregated pension pool, and you will move into an unsegregated pension pool because there could be other accumulating members in the fund. But if it was a 100% pension fund, you're looking at, the moving to an unsegregated or to an accumulation pool, where the reason why it is orange is because all the tax will be, all the income will be taxed in the fund. And it no longer remains a 100% pension fund because now it is a mixed fund. So let's just look at what the benefits are of actually claiming the CGT relief, and let's just understand the concept of CGT relief. And we'll take an example of a one-member fund which has only one asset. So on 30th of June, I'm ignoring the fact here that the fund is actually segregated or unsegregated. So we look at the pension assets. It's 2.6 million, and it's a house. Let's just say it's a residential one property, or it could be, say, BHP shares. So that's basically immaterial for our discussion here. But the asset was purchased quite some time back for 1 million. So you can see that the growth is actually 1.6 million. So moving forward, so the next day itself, we cannot have, because the asset value is 2.6 million, we cannot have 2.6 million on 1st of July. So on 30th of June, we have an option to actually have an accumulation account. So the accumulation account actually is born, or the commutation is born on the 30th of June, where you do a full commutation and you commence a pension on 1st of July. So basically, the commutation happens on 30th of June in the middle of the night. And in the morning on 1st of July, you have only 1.6 million. So for one single day, which is 30th of June, the fund remains in partly in accumulation and partly in pension. So what we've got is an accumulation of 1 million, and we have a pension account. And that accumulation account is 1.6 million, and the notional gain, that is the cost price, from 1 million to 2.6 million, the change in value over this period from 1997 to 2017, so say over 20 years, that notional gain remains in the fund, and it is 1.6 million. Now, when the asset is ultimately sold, so our new cost base is 2.6 million, and when the asset is actually sold for $700,000 more, we see that our gain, the cost price was only 1 million. The capital gain is actually 2.3, but we ignore the 1.6 million. The capital gain remains only 700K because our cost base has changed, because we have made that election, has changed from 1 million to 2.6 million. Now, what you see here, this is where the complications begin in, because after 1st of July till 2020, depending on the date, 3 years later, the fund has actually been in unsegregated mode. That means there are accumulating, there's a member, it could be the same member who has an accumulation account, and the same member has a pension account. And the value has since grown, because on that date, the value was 2.6 million, but the asset value has grown by 700,000. So it's possible that income, because the fund had a pension member also, it had some pension payments as well, but the asset actually grew, and that means the income was higher than the pension withdrawal. So maybe if it was a house, the rent could be 7 or 8 or 9%, and the pension withdrawal was only 4%. So the growth was 3 or 4% every year, and that made the value actually grow. And maybe the asset itself, the gain in market value over the 3 year period from 2017 to 2020, the value grew. But because it remained in mixed phase, in unsegregated phase, then what you need to do is, first of all, because it is more than 1 year, you have to apply the CGT discount, and then you have to look at a percentage method, and we are using approx because we don't know how the accumulation account moved and how the super fund pension balance moved. So we're just using an estimate of 1:6, because maybe he withdrew, maybe the accumulation account was credited more, the tax came out of the income of the asset, so we don't know the value, so we're just using an approximate. So this is just to show you that what you're in for, going from 1st of July, because if you had only a pension fund, you never had to worry about actuarial certificates, but from 1st of July, you will be applying for quite a few more extra actuarial certificates than you did in the previous years. Okay, now segregation could be of separate types of several types. You could have 100% pension segregation. That means you have two bank accounts and all the accumulating members are separate. Or you could have a separate type of segregation. That means some assets are segregated and there are some assets which are mixed, and there are some assets which are segregated only for accumulating members. So you can have, this is just to show you that some members could have different levels of segregation. So it's not only segregating a simple 100% pension fund. You could have situations where segregation is quite complicated in some of the funds. Now, let's just look at the unsegregated method. Now, when you have a fund which is unsegregated, that means all that growth the fund can have. There are some members who are in accumulation. So let's look at a fund, which I will do very soon with an example. The growth has been because of some of the income must be credited to accumulating members. So what we need to do is we need to determine whether the assets of the funds were unsegregated of 9th of November, and if they were, then you don't have a choice. Then you have to pick 30th of June to claim the CGT relief. Whereas where the assets were segregated, you could choose any date between 9th of November to 30th of June 2017. Whereas if the assets were unsegregated, you don't have a choice. All the assets will have a market value of 30th of June 2017. And then you work out the actuarial certificate, that is, what is the unrealized gain, and whatever the market value is, then you work out how much belongs to pension members, and then you work out the tax. Once you have worked out the tax, then you can select which assets you want to claim the CGT relief for. As I mentioned earlier, you don't have to choose each and every asset, and within a batch of asset, let's say Westpac, you can choose certain assets within that batch which you want to claim the CGT relief for. Then you have a choice whether to pay the CGT in 2017 and get it done and over with, because some of the growth over the years belongs to accumulating members, and I'm going to explain a little bit further. And that gain, because it's a sale, because it's a deemed sale, the capital gain is actually realized, but we call it a notional gain because it's not a real gain. But the tax can be calculated and CGT can be paid in 2017 year, or you can defer that CGT till the date the asset is actually sold. And this is where the complication is going to be, because it's possible the asset is never sold and the election is taken and the asset is held. So we're going to look at some examples very soon where we had certain assets and the CGT was calculated, and uh, and um, and then we're going to look at some examples where the election was not taken. So the question is that you have to make a decision, and the trustees need to make a decision whether they're going to make a election or not. And as mentioned earlier, election is irrevocable, and once it is made, you cannot go back and say that it doesn't suit you anymore. So that's going to be a problem. So the deemed sale actually for unsegregated assets must happen on 30th of June. So evaluation is very important on 30th of June. So you've got a problem right there. So if you've got funds which have pension members more than 1.6 million, and on 30th of June, you need to work out what the valuation is. Now, valuation could be very simple if they're shares. And I think auditors are going to have a very tough time. And I'm recommending to all auditors to actually qualify the audit report to say that we don't know the values of the properties which were held on 30th of June, because we are not real estate agents and this property were not put up on auction. So there are going to be a lot of trustees who are going to play around with these valuations. And if an unqualified report is issued, then it's possible that the ultimate sale of the asset could be at a much higher value, and if it is at a much higher value, then the auditor could be in a little bit of a strife. So what I'm suggesting to all auditors, that if you're auditing a fund for 2017 year, and if the member is on pension, if one member is on pension, and if CGT relief is being claimed, and that member had more than $1.6 million, you must qualify the audit report and let the tax office know in a contravention report to say that you are not sure whether that valuation is correct or not. Now, what I did mention earlier is that if there is a capital gain, that capital gain can be included and the tax can be paid, and we must get an actuary to determine the pension exempt factor. And if there is accumulation accounts, you definitely need one. And because your fund is going to move into accumulation phase on 30th of June, if the member has got 1.6 million, and if there is income earned in the fund on 30th of June, then you will need an actuarial certificate if you want to claim a deduction for exempt current pension income for that fund. Now you have the choice, you can defer the notional capital gain, and I'm going to explain you all that in an example very shortly so you will understand what the notional gain is all about. Now the date of acquisition will be 30th of June, and if the asset is sold, then you have to look at the CGT one-third discount will also be reset to be 30th of June 2017. Now you must have some documents, and you have to make the election, which again is irrevocable. Now what we are looking at is an unsegregated funds where the assets are mixed. We have pension accounts and we have accumulation accounts. Now when I was in my previous life, and I was looking at funds, I was looking at about six. I was administrating about 600 funds, and I would say about 400 of those funds had members who were in pension phase, and I would say out of those 400, we had only one fund which had segregation in it, but otherwise they were 100% pension funds. And if they were accumulating members, they none of the funds were actually segregated. None of the funds had an asset which was segregated. So either you will have a fund which is either on 100% segregated pension fund, or you will have 100% unsegregated funds where there are pension members and non-pension members. So all I'm trying to say is what's going to happen is that the date will be 30th of June, and all the assets will actually move to a mixed state. That means that if your pension member had 5 million and your non-pension member had 1 million, on 1st of July, you'll have a reverse situation. You will have the pension member above 1.6 million also rolling back into 30th of June. So the important thing here is to note that asset will be transferred to that accumulation phase on 30th of June, then to choose any other date between 9th November to 30th of June. So let's look at an example, because it's a very complex issue and it's very difficult to understand without an example. So we've got two members, and they had 3 million on 30th of June. The market value of all assets were 3 million. Henry, who's 62, he's retired. He's on pension with 2.2 million. Martha, his wife, 54 years. She's not retired. She's in accumulation with 800,000. Now, because Henry has got 2.2 million, he cannot have more than 1.6 million. So 600,000 has to move into accumulation. So we have total assets of 3 million on that day, 2.2 plus 8. An asset, just to make it very simple, it was purchased for 2.25. So we have 750,000 gain up to 30th of June. Now you must remember, I've picked the age for Martha to be 54. She's unpreserved. So all the gain which the fund has had, so the asset was purchased for 2.25 million. The gain which the fund has got 750 is during the period while Martha was in accumulation phase. So the funds were unsegregated. The reason they were unsegregated, it's one asset only, because Henry is in on pension, and because it's only one asset, you cannot segregate that asset. It's only one asset. And because Martha is in accumulation, so it has to be unsegregated, and because it's only one asset. So this is one fund you should be looking at for CGT relief, because there is a notional gain of 750,000. Now, Henry moves into pension phase on 1st of July, and Martha is 800,000 in accumulation, and Henry now has 600,000 in accumulation phase. So just to go over it again, Martha is in accumulation, so you can see Henry's balance is 2.2 million on 30th of June. So the changeover date is that on 30th of June, Henry will commute 600,000 and we will have 1.4 million on 1st of July. So the commutation for Henry will happen on 30th of June. So what are the four options? We have a gain, so we can sell the property in 16 or 17. We can pay the CGT based because Martha is in accumulation. We can pay the CGT based on actuarial certificate and then get it done and dusted. Or what we can do is we can reset the cost base. That means we make an election and the CGT can be included in the 2016-17 tax return. Or what we can do is we don't pay the CGT and we defer the CGT. Now, the reason why there is a gain is because Martha is in accumulation. You must appreciate it's a fund which is unsegregated. Now, we have looked at election in this case where CGT is paid, an election where CGT is not paid but deferred, and then we are going to look at a situation that Martha was 54, and when the asset is actually sold, Martha is actually moving into retirement phase, and then if an election is taken in 2017, what could be the tax payable? And if the election is not taken, so we have to see whether we want to reset the cost base, and maybe you choose not to take the reset of the cost base and let the fund not elect for the CGT relief. So let's look at the example. So there's a notional gain of 250. There's a 1/3 discount if the asset is we're looking at option 2. We are thinking of paying the tax. So there's a taxable gain of 500 and 2.2 is in pension phase. The fund is 3 million. So the exempt current pension is 366. The assessable 500 minus 366 is 133. 15% tax is 20,000. So let's pay the tax and get it done and over with. But what is important to note here, the assessable income is 133. So this notional gain can be deferred, and that's what is compared in the next option where Martha is not retired and the notional gain is deferred when the property is sold. So it's 2017. We are taking the property up to 4 million. So the cost base is reset at 3 million on 30th of June. So there is a real CGT of 1 million. Now on that date, we get 1/3 discount because the property has been held for 1 year. The property's cost base is 30th June. So the property is being sold 3 years later. So we get the 1/3 discount. So the taxable is CGT. But this is where it gets a little bit complicated. Now, the exempt portion, we are assuming again, you remember that we had only 1.6 million in pension. So the new balance is 4 million. So we had 1.6 million in pension and 1.4 million in accumulation. So I'm just assuming it to be half because if it is an accumulation, then it's possible. So we don't know this figure, so we have to see the real figures. And if it is an accumulation, I'm just assuming that Martha is making more contributions. So we had accumulation of 1.4 million. Now it is 2 million. So 1.6 has also gone up because of the revaluation of the asset. But uh, when we work out that exempt portion, it will of course depend on the actuarial certificate which will be obtained in 2020 year. So assuming it is half, so this is taxable plus the deferred gain. Remember the gain from 2.25 million to 3 million. So that deferred gain has to be added back. So then we add the yearly gain, which is from 3 million to 4 million. And then this gain represents from 2.25 million to 3 million. The total gain is 466. And then the tax on that is 70,000. Now, in this case, what we have done is we have taken an election, and then Martha retires in 2019 before the property is sold. So if you remember, Martha had a balance of 800,000. So there are more assets. There's more pensionable assets. So the exempt percentage will obviously increase. So let's go through this figure work here. So the selling price is 4 million, and then we are assuming that there is a growth. So we had Henry at 1.6 million. So his value grows to certain figure. It's just an assumption here. And Martha had 1 million, and then it also grows because she accumulated more money. So we had 3.5 million in pension phase, and Henry had an accumulation account of 400, which also grows. So we had 4 million. So all up, it's 4 million. So we get the one third discount from 3 million to 4 million. We get the one third discount. So the capital gain is 666,667. But then the exempt percentage is a little bit higher because Martha is now moved to retirement phase. So earlier on, we had a lower figure, we had 50%, but now we have 87%. So what we've got is the out of the 666,667, 583 is exempt. And the reason it is such a high exemption deduction is because Martha is moved into pension phase. We have a taxable component, and again, we have to add the notional component. The reason we have to add the notional component is because the actual purchase price is 225. From 225 to 3 million, the deferred gain has to be added again because we took the election, and once it is added, then tax is calculated and tax is paid. Now let's compare this where no election was taken, and this could be this could be very interesting for some of you who might be thinking whether this is a good thing or a bad thing. So let's say the selling price is 4 million, so the values have grown. Henry's value of the pension account has grown. Martha's value of the pension account has grown. So we've got 3.5 million in pension, and Henry is in accumulation, so the exempt percentage is 87.5. Now the cost base is no longer 3 million because we did not take the CGT relief. Our cost base is now 2.25 million. The growth is 1.75, and we get the one third discount because we bought the property sometime in 2004 or whatever. It's more than 1 year. The taxable gain after the one third discount is 1.1 million, but the exempt uh, deduction for ECPI is quite high. Now, as you can see, that Henry's value is 2.3. The test whether it has breached the exempt, the whether it has breached the balance transfer cap is immaterial because the value has grown over a period of time after 1st of July 2017. And as you can see, Martha is still at 1.2 million, so she's below the balance transfer cap amount. The exempt percentage is then calculated based on what the pension balance was to the value of the fund. So 3.5 divided by 4 gives you a figure of 87.5%. So whatever the taxable gain was, then the taxable CGT would be the remainder of the amount and only 21,000 taxes paid. Now, what we have seen with an example here is because Martha was so close to retirement and she had quite a high value, it actually gives you a better result than where the election was not taken. So here we had taken an election. So what we need to do is we need to add back the notional gain which was deferred. But here we don't have to worry about the notional gain. We just have to look at what the pension members were. Now, there's one strategy here before you sell. How about Henry decides to withdraw the 500,000 out of the super fund? And if he withdraws 500 out of the super fund, the fund will pay zero tax. The reason it will pay zero tax is because the fund would be 100% in pension phase. So there are a lot of strategies out here. So making an election is always not necessary going to be the best option for you. So now the question would be is should we or should we not take a CGT relief? And my answer to that would be it all depends. It all depends on the member situation. It all depends on the market value of the assets. And it all depends what the trustees want to do. So whether to reset or not to reset the cost base will depend on lots of things, and especially, and what is a major factor is whether the ECPI component would be higher in future years. So you'll have many situations where one member is on pension and the other member is not on pension. And also, when will the member retire? So it's possible that we may have only accumulating members. And when will the asset be sold? Will it be sold at a higher value or not? So if the asset was sold, so if we go back, if the asset is sold for say 2.8 million, the cost base is 3 million. So we don't know whether the selling price will be more than the cost base or not. And if the selling price is going to be less, then obviously there would be a CGT, a capital loss instead of a capital gain. So all of these factors need to be forecasted because it's an irrevocable election. Now, one of the things which I looked at and I just want to discuss here, Martha was 54, and what Henry could have done. Henry had 2.2 million, and only 1.6 million could move into pension phase. So he had $600,000 balance. He could have reduced his his accumulation balance by withdrawing 300 and giving it to Martha over the years. And Martha could have contributed because she didn't have 1.6 million. So, when Martha goes into pension, it's quite possible that Henry could have withdrawn 300,000 outside of super or done the recontribution strategy twice. So we could have a situation where there was no accumulation account for Henry. So these are the things which you really need to sit down and discuss with your trustees and, work out whether you're going to use the recontribution strategy. Are you going to commute some of the amount, or are you going to withdraw the money out of the super systems just in case if there's any tax payable in future? Excuse me. So the question is whether to reset the cost base or not, and what you need to consider. The first is you have to look at 9th of November. Um, See whether the funds were segregated or not segregated, and see whether the fund is eligible for the CGT relief. And then you have to look at whether the asset is going to be sold in the next 12 months, and then what would be the likely increase in the future value of the asset. So it's going to be a very difficult question. Now, if your trustees have assets outside of super, withdrawing out of super may not be tax beneficial because they could be paying a higher marginal tax rate. But if they have no assets outside of super and you have senior Australian tax offset, it's quite possible up to $45,000 your clients, a couple, will pay no tax. So, if the return is only 4 or 5%, so 1 million could be easily withdrawn out of super and kept outside of super because all that income would be tax free anyway outside of super. So, keeping money in super could mean that the fund would be paying 15% tax, but if you withdrew that amount, then it is quite possible that it would pay no tax. So this is a situation where trustees should consider, setting up discretionary trusts where they could, distribute income to other family members on a lower tax bracket. So if the fund had 5 million, only 3 point, and it had a couple, only 3.2 million can go into pension. The 1.8 million could be, probably invested outside. I'm not going to go into the capital loss situation. So there are certain funds which have an accumulated capital loss. So, you can look at this example when you download my slides and then work it way through. I just want to introduce ecpi.com.au. This is a new website which we have created, and this is a total digital disruption. If you buy 100 certificates, because you will not be able to segregate any pension assets from 1st of July, you would be buying a lot of actuarial certificates going forward. And if you have one member who's in pension phase and you're considering, investing the assets through the fund that is not withdrawing outside of super, and the total super balance is more than 1.6 million, you will need actual certificates. So it'll be a good idea to, you know, try to spend less. And um, the other day we had a webinar which we are going to upload on the website, where I have said that it's very difficult to calculate, because the ATO has changed his view on how you're supposed to claim exempt pension income. So it's very difficult for a software to actually work out the percentage. So earlier on, you used to order certificates via your software. Now it's not possible to do that because it's possible that the fund which you are doing the accounting for, the member could have two funds, and maybe the second fund has 1 million in pension phase, and this fund has got only 600,000 in pension phase. So you need to, the actuary needs to know whether there are other funds as well which will be claiming the exempt current pension income or not. So, I think we'll go back into manual processing and via a spreadsheet, and we have developed this new interface based on the new um, ATO's view. I invite you to have a look at ecpi.com.au to work your way through. Now, I also earlier mentioned about how are you going to report. Basically, there is a question in the tax return in the CGT schedule where you have to enter the information, and you have to say, the question is, have you chosen to apply the transitional CGT relief? And if you say yes, and if there is a notional capital gain which you want to defer, you have to mention that amount here. But record keeping is going to be quite cumbersome, and going forward, if you're going to inherit clients, you have to be very watchful that you get all the data specifically pertaining to CGT issues, 2017, whether an election was taken or not, and whether market value was correctly determined on 30th of June or not. So I'm just coming to the last couple of slides. So one thing you have to remember that you're changing, taxable and tax-free component, when we looked at the client, when we had Martha. So, it's quite possible that Henry had taxable component. So when you withdraw the amount, when you recontribute, it goes in as non-concessional. So there's a little bit of a estate planning to be considered here as well. So it's not only, using recontribution strategy between two members. If a member is able to withdraw and not pay tax on it, and this is where it's going to be very tricky, because if you're over 60 and not working, you could, withdraw any amount, and you have to be very, very careful on how you plan these recontributions from the age of 57 to the age of 60 and there onwards, and how you change the taxable component into tax-free component. Here we are looking at a situation where the fund balance is 5 million and there's husband and wife. So we have 3.2 million, which can go into pension phase or into retirement phase. So one of the options could be is you withdraw 1.8 million and you could invest 600,000, say, outside of super. And then the 1.2 million, I'm saying that you can contribute non-concessional with the bring forward rule, 300,000. So if you had two kids and both were married, so there were four people, four multiplied by 300, you get 1.2 million. So you could set up new funds for your kids where you could be members as well. And you could contribute 300,000 for each couple, each person in a couple as non-concessional contributions. You see, your money is going to go to your kids anyway. So, and it's going to pay tax because any amount above the balance transfer cap, it's going to pay 15% tax. So instead, my logic here is that instead of being in your accumulation phase, it could be in the kids' accumulation phase. And if it's in the kids' accumulation phase, then you're actually, handing over your assets to the next generation now instead of waiting later. So if it's a $5 million fund, we could have two funds here which are in accumulation, and then we have one fund which is a clean fund, which is a 100% pension fund. And the beauty of having this 3.2 million pension fund is that if it grows in future, if the income is more than the pension withdrawal, then this fund will always remain 100% pension fund. Now, one thing which we need to look at is that if you decide not to, have a fund which is, or you're not going to withdraw the money and hand it over. And if you decide to have only one fund where you have an accumulation account of 1.8 million, you could have an investment strategy where segregation of certain assets are kept for pension members. So assume that this is a fund, and since this is tested on 1st of July, 1.6 million balance transfer cap, certain assets could earn more money, and certain income of those assets could be allocated to the pension fund instead to the accumulation fund. So we're not segregating the asset for income tax purposes. What we are doing is we are segregating the assets for pension funds so that more income could be allocated to the pension account instead of the accumulation account. And the purpose to do that is because you would need an ECPI in this situation where there is one fund with 1.8 million in accumulation. But over the years, if you allocate more income, the pension account will actually grow faster. And if it grows faster, your exempt current percentage could actually change. And if it changes, then over the years, it's possible that the fund will have a higher balance in the pension account than in the accumulation account. The second strategy could be is that if you need more than the minimum amount, so let's say the minimum amount is 5% and you're over 65, so then if you want to withdraw, let's say you want extra $100,000 for a new car. So instead of withdrawing from the pension account, what you could do is you could deplete your accumulation account and over the years, then the accumulation account will reduce, and your exempt current pension income percentage will improve, and the fund could pay lower tax. So you have to look at SIS regulation 5.03, which talks about allocation of income. And if you're going to segregate the assets because of a certain investment strategy, then that should be allowed by your trustee. And you should be thinking of overwriting your software figures, because when the software allocates income, it just looks at the daily balance of the members. Some auditors don't like that. You're giving more income to pension accounts than to non-pension accounts, because regulation 5.03 says that you should be fair and reasonable in allocating income and expenses to various members. So you have to be very careful on how you do these allocations. So I'm about finished here. So I'm just going to go through. So those who have have no questions, they can leave the webinar now, and I'm just going to quickly answer these questions. I have a question by Dawn, and I'm going to read that question and I'm going to answer it. Those who want to stay online, and they can hear what other people are asking, and I'll try and answer them. So the next question by Raylene is that, is the CGT cost-based relief available to a member who is on TRIS but does not wish to continue the TRIS from 1st of July, as there is no more tax benefit in commuting to accumulation on 30th June? Really, that's the CGT relief is not applicable to those members who are moving into accumulation on 1st of July. So the member who is on TRIS must continue the TRIS into 1st of July 2017 to get CGT relief. The next question is by Gary. Why can't the transfer be at midnight of 3rd? You might be writing 30th of June. So I'm just reading this again. Why can't the transfer be at midnight of 30th of June, thus not having 1 day of income? Okay, yeah, this is very interesting. And my understanding is that on the morning of 1st of July, you should not have more than 1.6 million. So if it goes on the 30th of June, the way I have understood it, that on 30th of June, during the day, the member who has more than 1.6 million must commute any excess amount, and there should be a minute that it has been done, because you won't know the value. So my understanding is that it happens on the night of the 29th, so that when the morning of 30th of morning of 1st of July happens, it is on the morning of the 1st of July happens, not more than 1.6 million is in balanced, is in the pension account. So Gary, I don't know why it doesn't happen in the midnight, but what I have understood is that it remains in unsegregated mode for 1 day. So I have another question by Raylene. She says, can the trustee specify in writing that they are commuting uh, from pension to accumulation as at 11:59 on 30th June to avoid the fund being unsegregated for 1 day, or to argue there is no income earned in that 1 minute? Really, it's a very valid point, and I think you're absolutely right. If there was a minute, but I think what you should look at is you should look at whether the fund earned any income or not on that day. And it'll be very rare that the fund will earn income, and it's only that income which has been earned on that day, because the fund has been segregated all through the year, but it's on that day. And once you look at the income of that particular day, you may see that it may not be worthwhile. And if it was, then you have to see how much was in pension and how much was in accumulation. I think some people might be going for a private ruling, and I suggest you take it up with the tax office. Maybe you get a better answer than what you're getting from me. Okay, I've got another question from Michelle. She says, according to the LCG, members of the funds using the segregated method may receive TRIS during 16-17 year that continue past 1st of July, and the TRIS will not be in the retirement phase from that date. That is, the value of the interest supporting the TRIS will not be transferred to the accumulation phase before 1st of July. Is that only relevant for a TRIS? Yes, that's only for the TRIS, because although it's going the TRIS is going to pay tax, but it may have earned, because it was till 30th of June in the tax-free zone, and any gain in the tax-free zone has to be quarantined. So if the transition to retirement was, say, for 5 years, say it started in 2012 to 2017, and the asset grew, say, 100,000, so that 100,000 has to be quarantined, and it can only remain in quarantine if the TRIS continues. If the TRIS does not continue, that means everyone goes into accumulation, and if everyone goes into accumulation, then CGT obviously does not apply. So it's very important that TRIS continues. Now, TRIS can move into account-based pension as well, because maybe the member retires or the member turns 65. So the pension must continue. Let's put it this way. So if it's transition to retirement pension, it must continue. If it's an account-based pension, it must continue. I've got another question by Gulshan. He says, if there is no member with 1.6 balance or more, can segregation of assets be done in that fund? Well, if you don't, if the fund has, say, two members and both of their balances are below 1.6 million, then the fund is 100% segregated. Uh, the unsegregation is only valid if the balance is more than 1.6 million. So if the balance is below that 1.6 million, you basically don't have a problem at all. Okay, I have another question from Shadow. She says that, is there an actuary certificate required if two members both are in pension account with a total assets value below 1.6 million? No, you don't. You don't need an actuarial certificate, because if you look at section 290-385, it clearly says if the fund is in 100% segregation mode, then you don't need an actuarial certificate. So if husband wife both their balances are below 1.6 million and they both are in pension phase, the assets are segregated, that means that the fund will not need an actuarial certificate. Okay, I've got another question from Greg. He says, if a contribution is made on, say, 1st February 2017, and a pension is then instantly started using all of this money, where all the existing assets of the fund are in pension mode, is that the date for the CGT relief to apply to? Also, how does this affect ECPI? Okay, now what you're doing is that you are making a contribution and you're commencing a pension on 1st of February. CGT relief will not apply because the pension did not commence on 9th of November. Hold on, you're saying, I think your dates may be a little bit wrong, Greg. What you're saying is if a contribution is made on 1st of February 2017, so it is past the 9th of November. So the pension must be existing on the 9th of November. If the pension did not exist on 9th of November, then CGT relief does not apply, period. So if the contribution was made later on, and you bought assets later on, or you could have bought assets earlier, then you cannot claim any CGT relief. Okay, I've got a last question, which is from Don. Are you going to answer my question? Which is that question? Sorry, Don, I'm very much past my time. It's 3:30, so I'm going to stop the seminar, the webinar for everyone right now. Thank you for being with us. If you go back, you will see that I have added another webinar on valuation of assets, and I think those of you who have clients who have more than 1.6 million should uh, attend that webinar, because valuation is going to be a major issue going forward. And if you are an auditor of a fund which will have which will have clients with more than 1.6 million, I strongly recommend that you attend that webinar. Thanks for attending, and you can claim. I'm going to get CPD reviewed, CPD, this webinar approved for CPD hours. You can claim 1.5 hours. Make sure that you make an entry in your diaries. Thank you for being with me. Thank you.